Moneycontrol and Aditya Birla Sun Life Mutual Fund present Sahi hai Pathshala.
We all have that idle money kept in our savings account. But did you know that you can earn returns even on the surplus money? Surprised, right? Well, to help you just do that, Moneycontrol.com has instituted the series Sahi hai Pathshala in association with Aditya Birla Sun Life Mutual Fund. The sole objective of this investor education initiative is to handhold you on how to create a mutual fund portfolio that aims to enhance returns in a bull market while managing risks in a bear market, thereby emphasizing the key characteristics of a pro portfolio. Hello and welcome. I'm your host Karunya Rao, and joining me today on the show is Kaustubh Gupta, co-head fixed income investments at Aditya Birla Sun Life Mutual Fund. And today on the show, we discuss how liquid funds offer short-term investment options with high returns. Kaustubh, welcome on board, and let me straight away start by asking you, what exactly are liquid funds?
Look, liquid funds are open-ended debt funds which invest predominantly in debt and money market instruments up to 91 days of maturity. By regulation, although the fund mandate is to invest up to 91 days, but generally money market open-ended liquid funds, they run average maturity between 30 days to 75 days. These are the funds for the set of the investors who are conservative and who are looking to deploy their surplus money for the short-term period.
Okay. But can investing in liquid funds be seen as a good alternative vis-a-vis keeping your money in a savings bank account?
Of course. The point is that liquid funds returns, because they invest in up to 90 days papers, they generally earn little bit of term premiums over the overnight rates. These overnight rates are guided by the RBI depending on the macroeconomic situation. And usually these rates are significantly better than other sorts of traditional fixed income investments or surplus investments like fixed deposits.
Okay, but can you explain in simpler terms of what kind of annualized returns do they generate?
This depends on the liquidity scenario in the country.
Okay.
For example, if the liquidity scenario in the country is tight, which means that RBI is not accommodative but little bit hawkish, then the term premium for these 60 to 90 days papers, it ranges between 50 basis point to 150 basis point. If the liquidity is neutral, like in the current scenario, then the premium for these funds, it moves between 50 basis point to 100 basis points. And if the liquidity is surplus, like we saw post-COVID scenario, then the premium ranges between 0 to 50 basis points. So approximately, you can say that likely returns, it's dependent upon the liquidity scenario, which is guided by the RBI, depending on their assessment of macroeconomic situation.
And when you say liquid funds, how liquid are these liquid funds, and are there any kind of risks or potential risks associated with it?
As the name suggests, these are liquid funds.
Yeah.
Now, from the risk perspective, any debt fund, it's basically exposed to three kinds of risk. One is liquidity risk, credit risk, and duration risk. First of all, the duration risk is concerned because these funds invest up to 90 days papers, and average maturity that these funds usually runs is between 30 days to 75 days. The exposure to interest rate risk is very, very limited. Having said that, although the exposure is limited, but it exposes to the investors to the daily mark-to-market fluctuation because these funds are mark-to-market on daily basis. Then comes to the credit risk. Again, these funds invest in a highest quality short-term rating papers. So the credit risk in these funds is very, very limited. And the third part, which is liquidity risk, so there are two answers or two parameters to it. First, most of these funds, they run very high liquid assets, and by regulation, they are also mandated to run liquidity coverage ratios anywhere between 20 to 25%, which means that these funds invest in sovereign dominated papers anywhere between 25% minimum.
Okay.
Because the average maturity is closer to 50 to 60 days, on an average, the way the portfolio is constructed, 20% of the portfolios get matures every week. So in sum and substance, the liquidity risk is very, very limited.
Okay.
Credit risk, because they are invested in highest rating papers, again, the exposure to that front is quite limited. And interest rate risk being the average maturity closer to 50 to 60 days, that risk is also somewhat limited.
You know, we started the conversation by talking about idle money lying in your savings account.
Yes.
So, would you say that liquid funds should be considered to invest your surplus cash, or should it be part of your core portfolio?
I would say that it can be thought out on both portion.
Okay.
First of all, whatever is your surplus money, which is lying in traditional source of investment like fixed deposits. So, this is a better way to optimize return, or from a taxation perspective as well, and from a return perspective as well. So, that money should ideally, anyway, from an efficiency perspective, should immediately switch to these categories of funds. The other way of looking at things is that when interest rates are in a rising scenario, at that time, from the fixed income allocation perspective, because these funds, they don't expose yourself to a significant interest rate risk, it can become part of a core asset allocation of fixed income investment as well, for a temporary parking till the time the normalization in the interest rates happens.
Okay.
Thus, we can say that these funds can be looked both from a core allocation perspective as well, and tactical allocation as well.
And if one wants to make it part of their core portfolio, how much of a percentage exposure would you say one should have?
It should be guided by your asset allocation profile.
Okay.
I would say that if you are looking for something with the investment horizon of 7 days to 14 days, then this is the ideal place to be as a part of your core allocation. Beyond that, there are other categories of debt funds which can be better as compared to these categories.
All right, Kaustubh, thank you so much for taking time out and for chatting with us and telling us all about investing in liquid funds. Hope you guys also had a lot of interesting insights to take away from this conversation. That's all we have for today. Thank you for watching.
Moneycontrol and Aditya Birla Sun Life Mutual Fund present Sahi hai Pathshala. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.